Hello there. Thank you for joining us today. I'm Marche, the webinar director at Advice Chaser. Before we introduce our guests and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and could not be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, now that we've gone through our disclaimer, I'd love to talk to you a little bit about what's going to happen today. Attendees are muted, but we encourage you to ask questions using the chat box, and the presenter will answer those queries during or after the webinar today as appropriate. We do have a question and answer period at the end of the presentation. If you ask a question in the chat box and we're not able to get to it, go ahead and leave your number as well, and we will make sure someone reaches out to you after today's event to address your query. Once again, we want this experience to be as educational as possible. Please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to today's guests. Our moderator today is Joe Dallow, and Joe graduated from Lawrence Technical University with a Bachelor of Science in Electrical Engineering before completing his law degree at Thomas M. Cooley Law School at Western Michigan University. Joe's engineering background combined with his legal training and financial planning background gives him a logical problem-solving approach to estate planning. And he is an analytical, outside-of-the-box thinker. He crafts creative solutions for his client. He is a family man, enjoys spending time with his wife and their 3 children. He also loves traveling, sports, and technology. And Joe, go ahead and come off of mute and say hello so we can see you.
Hi, everybody. Thank you, Marche, for having me, and Will also. I believe you're going to introduce Will and give his background, and we will get started on talking about the employee retention credit.
Excellent. William Manser has a bachelor's degree in accounting from Michigan State University, as well as a master's. Isn't that correct?
Yeah, master's degree in finance from Walsh College.
That's correct, yeah. He worked for PricewaterhouseCoopers, UHY, and subcontracted for various small firms, and has also worked as a sole practitioner. He was a prior partner with Ted Funke and Associates, and is currently the managing director of WJM CPA PLLC. And so I'm going to go ahead and turn the time over to you, Will, and let you get going.
All right, thank you. Thank you again for having me. Excited to be presenting again. And I think one topic that's really interesting and can be a huge benefit to businesses, a lot of cash on the table for this credit if you qualify, and was really something that the government put out to help people during this pandemic. So without further ado, I guess let's talk the employee retention credit. So employee retention credit, this was passed with the first coronavirus bill. You're going to see interchangeably ERTC or ERC, employee retention tax credit, or employee retention credit without the T for tax. Same credit we're talking about here, just to clarify that. It's basically a credit for wages paid during the pandemic, starting March 12, 2020 through the third quarter of 2021, paid during government shutdown and periods of decreased business. In the first coronavirus bill that was passed, PPP loan recipients are disqualified from claiming this credit. So I say that at first because it really was not a big topic when you all of a sudden disqualified everybody from who received the PPP. Majority of business got a PPP loan. We weren't talking about employee retention credit much until the second coronavirus bill passed, where PPP loan recipients were then allowed and qualified to apply for the ERC, going back to when it was enacted March 12, 2020. So once PPP loan recipients were now eligible for the credit, this really became a big hot topic and one that a lot of taxpayers can take advantage of. So we're going to talk 2020 and 2021. First, 2020, of course, because we have different rules between the 2 years and how much you can qualify for and how big the credit can be. So first, talking 2020, you must be an eligible employer, which there's quite a lengthy list of who qualifies, who's an eligible employer. Generally, most businesses qualify as an eligible employer. More importantly, are the tests you have to apply, whether it's a gross receipts test, which for the 2020 employee retention credit, you have to have a 50% decline in revenue of one quarter in 2019 compared with the second with a quarter in 2020. So for example, if most people suffered, that second quarter of 2020 the most, so you'd be looking at Q1 2020, Q1 2019 revenue compared with Q2 2020 revenue. Excuse me if I made that confusing. You're simply looking at quarter versus a quarter comparison from 19 to 20. The other test says if you were shut down fully by a government agency or even partially, you can qualify for the employee retention credit. So not everybody maybe experienced a significant decrease as much as 50%, but if you're shut down by a government agency and suffered severely in your business, you could qualify for the employee retention credit. Basically how the credit is calculated is you're given a credit of up to 50% of the qualified wages you pay, up to $10,000 per employee. You look at each employee on an annual basis, so even though you might be able to file over multiple quarters, you can only claim up to $10,000 of wages per employee throughout the whole 2020 year. Even if you try to claim, the ERC for Q2 and Q3 2020, you can only look at one employee's wages and aggregate up to $10,000. So what does that mean? You can get up to a $5,000 credit for employer taxes paid on each employee that qualifies. It could have been filed with the original 941. A lot of people, even payroll companies, were not up to speed, and there were so many changing laws that most people are amending their 941 to claim the credit. So that's where we say here, you could have filed it originally with the 941 and gotten credits with that originally filed form, or simply what we're doing is amending the quarterly 941 payroll forms to claim for prior quarters that have already passed. 2021, we saw some changes in the qualifications, primarily, which was huge and really is making this a bigger credit for there are two things that are really making it a bigger credit for 2021. One, the decline in revenue now only needs to be 20% of any quarter, still looking at 2019 because that was a normal year, versus 2021. So a lot of businesses have suffered at least a 20% reduction. So this kind of really opened the door for 2021 for more employers. So we're looking at any quarter in 19 to 2021. We can claim this for the first 3 quarters of 2021. They recently passed legislation to remove it for the 4th quarter of 2021. So if you've experienced a 20% reduction in revenue, any quarter in 19 versus any quarter in the same quarter in 2021, you can claim the credit. And we still also have the other qualification of being shut down fully or partially, which, many businesses still were in 2021 shut down, at least at some capacity. The big factor which makes this a much more valuable credit in 2021 is that it's now 70% of qualified wages. So you can receive up to $7,000 per employee and up to their $10,000 of qualifying wages. More important, even bigger than that, is that you can claim it quarter over quarter. So you look at an employee's wages, one quarter totally separate from another. So essentially you can get up to $21,000 per employee for the first 3 quarters of 2021 if you qualify. Whereas before you were limited to just a $5,000 credit on up to $10,000 of wages. So really big in 2021 that now you can pretty much triple up on any employee if they're paid up to $10,000 in each quarter of 2021. Because we were a little more familiar with this credit going into 2021, you could have reduced your actual employment tax deposits that you would have ordinarily made and, filed for the ERC as you held back on the deposits, or you could have even requested an advance credit But we're still kind of seeing a lot of people did not take advantage of this. So I would say majority were still amending the 941 to try to go back and claim a refund of the ERC. Here's kind of a nice summary chart that just kind of breaks down and I think makes it a little more simple. We have a 2020 and 2021 category. Credit type is the same. It's both a refundable payroll tax credit to eligible employers. Credit applicability is from March 12th, 2020 through December 31st, 2020. And then in our 2021, we can look at wages starting after December 31st, 2020 or January 1st, 2021 through September 30th, 2021 or before October 1st, 2021. Big differences here to highlight again is the credit amount is 50% of wages up to $10,000 in 2020, and in 2021 we're 70% of up to $10,000 in wages, and we can see our max credit is $5,000 per employee because we can only claim it once per employee in 2020, whereas 2021 we can claim it over multiple quarters for the same employee, giving you possibly up to $21,000 credit per employee. We've had a lot of new guidance, and it's kind of almost scary to present on this topic because of how many changes we've had and more guidance where we thought maybe, oh, these wages might work and these wages might not work, or, you know, do we have to worry about combining certain other grants or PPP? So it's very cautious to say very up to date. And what I'm saying maybe in this presentation might no longer be true in the next presentation because of all the changes. So I just wanted to point out that there is a lot of new IRS guidance. They also now allow you to look at a prior quarter gross receipts from the quarter that you are claiming the credits. This is really important in the gross receipts test because, you know, as you're either forgiven a PPP, that which now becomes an income item, or you're given the shuttered venue grant or restaurant revitalization grant. The IRS has told us you don't have to include those grants in your revenue calculation. So they simply want to look at normal business operation sales when comparing sales from quarter to quarter. Really big deal, especially since a lot of people were getting PPP forgiveness during 2021. They changed the eligibility to now allow employers with 500 or less employees to qualify, whereas before you had to be a business that was 100 employees or less. One big thing with restaurants or any service industry businesses that employees do receive tips. The IRS has given us official guidance that says employee tips are considered qualified wages, and that's because FICA taxes are paid on those reportable tips. The last topic, which is a tough topic to go through, we're briefly going to touch on it, is a controlled group analysis. I think our next slide goes into a little more detail on that. So I won't bore you with all the detail here, but essentially what the IRS has told us and what we need to be aware of is that if any owners have significant ownership in another entity, primarily greater than 50%, the IRS tells us you have to look at those entities as a whole. So whereas one business owner might meet that revenue decline test, they want you to combine all revenue from all controlled groups to compare revenue to revenue, because when you combine maybe a business that operated and thrived throughout the pandemic, possibly not too many businesses did, but if they do, you might no longer qualify. So there is a whole list of what consists of a controlled group and what companies do you need to combine in determining your eligibility for the credit. The refund. So like I said, primarily we filed, and you're seeing a lot of the ERC credits being claimed on the 941X, which is amended quarterly return. On a formal 941, you might get your refund within 30 to 60 days. And currently with the 941 amended returns, we're finally starting to see some refunds from the IRS come through. And that's the big question, because some of these ERCs are coming out to significant numbers, and clients and taxpayers saying, hey, we really want that refund. But unfortunately, we've been seeing it take as long as 6 to 9 months to actually get a refund on an amended 941. So basically here we just ask that you stay patient, and the IRS is asking us to stay patient. because it could take a decent amount of time with their backlog and how busy they are. And, during this pandemic, you can also request on the 941 that you get a credit carried forward to like a current quarter 941, which, if you didn't want to get the refund check, you could apply it. We're kind of running out of time now. I mean, with the third quarter of 2021 being the last quarter that we can claim this credit, I guess this is our last quarter to be able to apply credit to the originally filed 941. This is a big question because a lot of people are asking, what's our deadline? When can we claim this this credit? And generally what it is a 3-year statute of limitations, similar to your personal tax return, a Form 941 from the later of filing the return or the due date. You have 3 years to amend that return. So it's similar to any other statute of limitations. We've got 3 years from when that return was filed or the due date of the return to claim this. So we still have a lot of time. There's not a rush on it. And I understand the rush because of, getting the refund and getting this credit could make a significant difference in your business. But just in general, we have 3 years to claim it. PPP recipients. This is a really big deal because you really need to look across the employee retention credit, PPP, possibly any other grants like the Restaurant Revitalization Fund or Shuttered Venue Operation Fund. But it's very important you coordinate the wages claimed on your PPP loan forgiveness, including R&D credits, work opportunity tax credit, with the employee retention credit. Because what we've learned is that you can't double dip. So if you use wages to claim employee retention credit, you really need to have enough wages used for PPP so you get full forgiveness on that PPP loan, because you can't double dip an ERC credit or an R&D credit or workers' opportunity tax credit or PPP forgiveness wages with wages you're using for the employee retention credits. The PPP2, I mean, as we're saying here, it covered a period across multiple quarters. So you might want to extend those wages of the PP2 forgiveness on your application. Another idea is to utilize your non-wage expenses that the PPP allows. That way, you have more wages you can allocate to the employee retention credit. And, the second to last bullet, it applies for all available programs. So you really want to be cautious and take an analysis and an overview look of what are all these grants you've received or this PPP forgiveness along with the ERC. And, last bullet point of being cautious of all the government grants because they can't be double dipped. I already mentioned, one example is a Restaurant Revitalization Fund grant. So I think as we recommend, because this does get very complex, try not to go at it on your own. Make sure to work with your CPA. These changes are coming out rapidly of kind of, as you saw in a previous bullet point, almost every other month we're getting further guidance and there's new legislation possibly going to pass as we all know. You just want to coordinate, make sure everything is right. And you want to make sure you're working with the right professional that's going to help you determine what is the best option for you. Because the ERC at 70% tax credit might be more valuable than a PPP forgiveness. But I'm not making any firm statements because you really need to look at each taxpayer on an individual basis and weigh your options across all these, different loan forgiveness or credits that you can claim. We're at the Q&A. I think I went through there pretty quickly.
That's all right. I know we have some questions lined up for you, Joe. Go ahead.
Yeah, we have some questions. Okay, so what about if you don't have employees but have all independent contractors that work under you? Are you eligible for the ERC?
Yeah, good question. And my quick answer is unfortunately no, because this is a payroll tax credit based on your 941 forms where you are paying as an employer Social Security and Medicare tax. Since you're not paying that Social Security and Medicare, FICA tax on the payroll, 1099 non-employee compensation is not reported on a 941. So no, you cannot claim this on 1099 recipients.
Okay, so I know there are different entities that you can file under if you're a solo not necessarily a solo proprietor, but if you work by yourself, you're a single business owner, um, can you apply for this in that situation?
Are we talking like Schedule C?
Yeah,
Self.
maybe I don't know if there's a if I know that okay, there's Schedule C and then there's C Corp, S Corp, whatever. Are there differences between them, or can you apply anyway, or how does that
Yeah,
work?
I think the key here is, do you file for 941 payroll forms? There are certain credits like employee family paid leave act, I believe, where you can claim it on a Schedule C with your 1040. That um, those credits are not eligible to Schedule C self-employed individual. If you've paid wages on a Schedule C to other employees and you file a Form 941 and paying their Social Security Medicare tax, you can claim it there. But this can't be employee retention credit cannot be claimed on self-employment income to yourself. And then actually, which we didn't really cover it here, there are really strict rules of if you can claim it on an owner or their spouses or family members. I think we tried not to get too detailed in that, but there are special rules. So you have to be very cautious on claiming it on yourself as an owner. And I guess my quick answer, my long-winded answer is that, but my quick answer is no, you cannot claim an employee retention credit on a Schedule C if you're self-employed for your own income.
Okay. Um, with all the changes from 2020 and 2021, is it safe to assume that the IRS will come out with new guidelines for 2022 or maybe in the next couple of years?
Yes, I wouldn't throw out us getting more guidance from the IRS on the 2020 and 2021 credits. As we see more complexities, they probably will give us more guidance. But as it stands right now, this credit is expired as of September 30th, 2021, and we don't see anything in sight that's going to open the credit in 2022.
Okay. So this is a question from me actually. I saw on the slide with controlled groups. Are when you say that you're an owner of 50% of more than one entity, I see that you said brother sister corporations. So is this if I own over 50% on two separate unrelated companies, or do they have to be in the same field or whatnot?
Yeah, I would say this really applies. It doesn't really matter in what industry or what type of business, but if you have more than a 50% interest in two totally unrelated businesses, you have to look at, and I think this comes down to, because sometimes you have shared employees among companies and they want to make sure all the wages are there. And I think the biggest point of it is they really want to see you as a business owner. Did you have significant suffering from this pandemic? So if I think what they're really telling us too is it's quite unfair if you have a very successful business that was maybe doing very well, and then you have one business that was not doing well, you're still not doing pretty well among all your own businesses. But they're really trying to target businesses that have suffered significant revenue decreases or shutdowns.
Okay. And so let's say as a business owner, if you qualified for a PPP loan, but you haven't applied for forgiveness yet, can you apply the ERC and potentially get a bigger credit? Or I know you said no double dipping, but I wasn't sure on that.
Yeah, so you can't, it doesn't really matter when you apply for forgiveness. If you've already applied for forgiveness, well, now you're stuck and you have to deal with, whatever maybe is remaining left over and claim it for the ERC. But it's not a matter of, when are you getting forgiveness? It's overall those wages can't be double dipped. So maybe if you claimed an ERC and you realize you didn't pay enough PPP wages for full forgiveness, that could hurt your forgiveness situation. So you really want to, and it's also kind of was a good idea maybe to not claim the 941, because you don't know if revenue decreased, you don't know if which one might be more beneficial. But at the 70% credit, we're seeing that it could be more beneficial financially and more money in your pocket by claiming the ERC rather than full PPP forgiveness. So I think it's really important to, take a step back, look at all your grants, look at all your PPP loans, your forgiveness, and the ERC, and see what's going to be most beneficial, because it's been very clear in all the guidance that you cannot double dip on any of these wages.
Okay. And then just for kind of like a clarification recap kind of thing, can you give a quick overview of the PPP and what was that used for?
Yeah, so PPP was the Paycheck Protection Program. We've had 2 rounds of those loans you're eligible for. I believe you cannot apply anymore. It has been closed. But it was a loan to help companies with wages and paying employees. So you would look at 2.5 months of average payroll paid, and the SBA were giving you Paycheck Protection Program loans via a loan provider, whether a bank or credit union or other small lenders. And then if you use those appropriately, which the first PPP versus the second PPP had 2 totally different, not totally, but 2 different ways that the money could be used. The second PPP allowed for a little more of operational expenses to be forgiven. So if you use those funds appropriately and as required, you can apply and have those loans totally forgiven, meaning it was free money to spend on your employees' wages or those other qualifying expenses. And, most people qualified for a first and second round. And a lot of PPP ones, even PPP two loans have been totally forgiven. So it was essentially free money to help run your business during this pandemic. Although it was called a loan, they are actually honoring, and we're seeing these loans being totally forgiven. So it was a good opportunity, especially during the pandemic. They were getting this money out fast to businesses that were in need and suffering. So overall, a good program that really helped out some businesses, and is just a loan based on, wages paid out of a business.
All right, well, I believe that's all the time we have for questions. I did have a question that came out about will we get a copy of the information in this recording? We will post this on our website, and also you will get a link to the replay of this event after we are done. So thank you so much, Joe and Will, for being here. I really appreciate your expertise. I want to thank the organizations that have made this webinar possible today. And thank you to our attendees for attending. Here at Advice Chaser, we're all about helping you find a financial advisor who is a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. So once again, from Advice Chaser, thank you, Will, thank you, Joe, and thank you, guests. We will see you at another webinar soon. Bye, everyone.